Sage here for kalkinemedia. Please subscribe to the channel and press the bell icon to be notified of the latest videos. In today's trending topic we're covering, is inflation here to stay? Read what James Dimon of JPMorgan says as nations continue to recover from the COVID-19 induced recession. The highest inflation levels seen across the economies in more than a decade are rolling the markets. In China, which happens to be the world's second largest economy, factory gate prices in the month of May rose by 9%, their fastest annual pace in over 12 years, owing to surging commodity prices. And in the US, the world's largest economy, consumer prices for May accelerated at their fastest pace in nearly 13 years as inflation pressures continued to mount in the economy. And these numbers outline the global inflation pressure at a time when central banks and the governments across the world are trying to catalyse the post-pandemic growth, having lost one good year to the pandemic. And all these numbers have increased the risk of stagflation in the economies as inflation has peaked at a time when growth has plateaued. However, there is a silver lining here as the inflation numbers are expected to be short-lived, and it may not even lead to reactions from the central banks across the world. That is what most of the analysts and opinion shapers are discounting for, but they are correct in their assertion, aren't they? The world's top bankers, who control billions and trillions worth of businesses in Wall Street, are of different opinions. And they believe that inflation is here to stay for a long time. And JPMorgan Chase Co, the only Wall Street bank to make it to the list of top 5 largest banks globally, has been effectively stockpiling cash and not using it to buy treasury bonds or other forms of investments because of the possibility that higher inflation will force the Federal Reserve to increase the interest rates. To put it simply, the largest bank by assets in the US has positioned itself well to benefit from rising interest rates, which will give it a legroom to buy higher yielding assets. And we have a lot of cash and capability, and we're going to be very patient because I think you have a very good chance inflation will be more than transitory, says James Dimon in his own words. Long-time JPMorgan CEO said that at Morgan Stanley US Financials Conference on Monday. Again, he added, if you look at our balance sheet, we have $500 billion in cash. We've actually been effectively stockpiling more and more cash, waiting for opportunities to invest at higher rates, Mr Dimon said. Mr Dimon also expects to see higher interest rates and more inflation, and assured that the bank is prepared for that. Known as one of the most prudent CEOs on Wall Street, Mr Dimon is the latest to jump into the ongoing debate on whether the current high inflation is a result of temporary aspects of the reopening of economies, like dearth of raw materials or supply chain issues, or could it be more lasting? And this has led to financial markets split into two camps, with the US Federal Reserve on one side and many other private parties on the other side. While the Fed officials have called the current spike in inflation transitory in nature, meaning temporary and short-lived, however, there is a growing chorus of voices, including that of Deutsche Bank economists and hedge fund billionaires, who have warned of consequences should the Fed ignore inflation. Until now, the central banks across the globe have reacted to inflationary trend by pausing the interest rates. The words of Mr Dimon seem to have been echoed by James Gorman, CEO of rival Wall Street bank Morgan Stanley. And on Monday, Mr Gorman said in an interview to a TV channel that he also thinks that higher inflation may be lasting in nature and that the Federal Reserve could be forced to increase the interest rates earlier than expected. The question is, when does the Fed move? It has to move at some point, and I think the bias is more likely earlier than what the current dots suggest, rather than later, said Mr Gorman in his own words. And meanwhile, JPMorgan's decision to pile up cash accounts for about half of the decrease in the anticipated net interest income, or NII, this year. And Mr Dimon added, the other half of the dip, however, comes from lower credit card balances, and he said that as well. The bank now expects $52.5 billion in NII in 2021 and 454 basis points down from the $55 billion mark it anticipated in February. Thanks for joining us on that report. If you like the information, please like, share and comment on the video below, and subscribe to the YouTube channel. Press the bell icon to be notified of the latest videos, and for more information and regular updates, please head to the website kalkinemedia.com. This is Sage for Kalkinemedia.